What happens when the pursuit of profit overshadows ethical boundaries? The story of Enron is a potent reminder of how devastating the consequences can be. In the late 1990s, Enron appeared to be one of the most innovative companies in the world, pioneering in the energy sector. But beneath this facade of success, a far more complex and ethically questionable picture was forming. Initially, Enron's business model seemed sound, focusing on energy, commodities, trading, and services. However, as the company ventured into new markets, its leadership, driven by ambition and greed, began to manipulate its financial statements. The use of mark-to-market accounting allowed Enron to record potential future profits immediately, a practice that dramatically inflated their financial health on paper. The turning point came with the creation of special purpose entities, or SPEs, which Enron used to hide massive amounts of debt from its balance sheet. These entities, complex and opaque, were managed in a way that misled investors and creditors about the true state of Enron's financial health. As Enron's stock continued to rise, the executive team, including CEO Jeffrey Skilling and CFO Andrew Fastow, pushed even harder on these deceptive practices. They presented a facade of a thriving company, while internally they were aware of the burgeoning financial struggles. This deceit reached its peak when Enron reported its financials showing substantial growth and profitability, numbers that were largely a result of their manipulative accounting practices. The bubble burst in October 2001, when Enron was forced to admit it had overstated its earnings by almost $600 million over 5 years. This confession triggered a crisis of confidence among investors, and Enron's stock price, which had peaked at $90, plummeted to less than $1 by the end of November. By December 2001, Enron filed for bankruptcy, at that time the largest in American history. The fallout was catastrophic. Thousands of employees lost their jobs and their life savings, investors lost billions, and a ripple effect shook the global financial markets. The Enron scandal serves as a stark reminder of the critical importance of ethics in business. It highlights the destructive potential of unchecked ambition and the catastrophic consequences of a corporate culture that prioritizes profits over integrity. Moreover, it underscores the necessity for transparent and accountable corporate governance, as well as robust regulatory frameworks to prevent such disasters in the future. In reflecting on Enron, the lessons are clear. Ethical boundaries are fundamental, transparency is essential, and accountability is non-negotiable. For businesses aiming to not only succeed, but also sustain, these are not merely options, they are imperatives.